For years, the market insisted that XRP's biggest obstacle was uncertainty. Regulatory pressure, legal ambiguity, institutional hesitation, these were presented as the reasons why price remained suppressed. And now, that uncertainty has largely been resolved. The legal overhang has weakened, the narrative has shifted. By every conventional metric, this should have been the moment XRP finally repriced. But it didn't. Instead, the market responded with silence. Price remains controlled, almost indifferent, as if the outcome that everyone claimed to be waiting for never actually mattered. And that creates a paradox that most participants are not equipped to process. Because if clarity was the catalyst, and clarity has now arrived, then the lack of reaction is not a failure of the asset. It's a failure of the interpretation. So the real question is no longer whether XRP has won. The real question is why it doesn't look like it. And more importantly, who understands what this phase actually represents and who doesn't. The market is behaving as if nothing meaningful has happened, and that is precisely what's creating the confusion. Because from a retail perspective, the sequence should have been simple. A prolonged legal battle reaches resolution, uncertainty fades, and price responds aggressively. That is the expectation most participants were conditioned to believe. Good news creates momentum. Momentum attracts attention. Attention drives expansion. But XRP is not following that script. Instead of acceleration, we're seeing compression. Price moves upward, then stalls. Breakout attempts form, then fail. Volume appears, but it doesn't sustain. The structure is not explosive, it's controlled. And for many, that reads as weakness. But that interpretation depends entirely on the assumption that markets react instantly to information. And that assumption is where most participants go wrong. Because what we're seeing is not a lack of demand. It's a mismatch between visible demand and absorbed demand. Every time price approaches a key level and fails to break through, the immediate conclusion is that buyers are exhausted. But what if that's not what's happening? What if those levels are not rejection points, but transfer points? And this is where it becomes interesting. Because when a market stops reacting to what should be bullish news, it usually means the participants who needed that information are no longer the ones driving price. What most participants are interpreting as stagnation is, in reality, a transition. Because markets do not move from uncertainty to expansion in a straight line. There is an intermediate phase that often goes unnoticed, precisely because it does not produce the kind of price action that attracts attention. It is slow, controlled, and structurally quiet. And for those conditioned to react to volatility, it feels like nothing is happening. But this is not inactivity, this is absorption. When an asset spends extended periods moving sideways after a major narrative shift, it is not signaling weakness. It is redistributing ownership. The participants who entered based on speculation begin to lose patience, while a different class of participants begins to position with a longer time horizon. The process is subtle, but it is measurable through behavior rather than headlines. This is where XRP's identity begins to change. It is no longer being evaluated purely as a tradable instrument driven by hype cycles. It is being repositioned as infrastructure. And infrastructure assets do not behave like speculative assets in their early transition phases. They stabilize before they expand. But that raises a more important question. If this phase is not driven by retail momentum, then who is actually accumulating during this period? And why now? Because the answer to that question explains why the market looks quiet, right before it doesn't. The answer begins to emerge when you shift your focus away from price and toward behavior. Because institutions do not enter markets the way retail participants do. They do not chase momentum and they do not react emotionally to news events. Their objective is not to capture a short-term move. It is to establish positioning within a system they expect to expand over time. And that positioning requires time, structure, and most importantly, stability. This is why the current phase matters more than most realize. While price appears stagnant, the underlying framework around XRP is evolving. Ripple is no longer operating as a speculative blockchain project attempting to gain relevance. It is aligning itself with regulated financial infrastructure. The pursuit of licensing, the integration into cross-border payment corridors, the conversations around interoperability with existing banking systems, these are not retail narratives. These are institutional prerequisites. And institutions do not build on uncertainty. This is where the shift becomes visible for those paying attention. The same entities that once remained on the sidelines due to regulatory ambiguity now have a clearer pathway to participation. Not through speculation, but through utility. Not through hype, but through integration. And this is where it becomes even more interesting. Because when infrastructure is being built quietly, price is often the last variable to respond. Which raises the next question. If institutions are positioning during this phase, why does it still feel like retail hasn't arrived? The reason retail hasn't arrived is rooted in timing and perception. Retail participants are conditioned to react to headlines, to price spikes, to the visible drama of markets. They expect clarity to trigger an immediate surge. They expect confirmation to appear in every chart candle. But what is happening with XRP is almost invisible to that lens. Regulatory clarity has arrived, yes, but it is subtle. Commodity classification removes a legal barrier, but it does not instantly create demand from traders looking for quick profits. Institutional corridors are opening quietly, but retail cannot see them in real time. Banks integrating RippleNet or exploring Federal Reserve rails do not generate trending tweets or viral YouTube shorts. This creates tension, a momentary psychological dissonance where the market has won on an operational and structural level, yet appears flat to conventional observers. That dissonance is exactly what defines the accumulation phase. Most participants will interpret this as indecision. Most will exit. Few will recognize that the groundwork for the next phase is being laid beneath the surface. And this is where the true catalyst hides. The alignment of regulation, infrastructure, and patient positioning will set the stage, a stage that very few are mentally prepared to recognize. Now, consider the patterns that precede major expansions. Markets rarely move from boredom to frenzy without a preparatory phase. There is always a period of silence, of controlled accumulation, where the most informed participants position themselves while others lose interest. Price appears stagnant, volume appears modest, headlines seem inconsequential. But beneath that surface, a structural shift is occurring. XRP is in exactly this stage. It is quietly transitioning from an asset primarily traded for speculation to one that functions as a bridge within institutional payment flows. The infrastructure is being positioned, legal barriers are falling, and the participants with the longest time horizons are quietly absorbing. History shows that these phases reward patience far more than reaction. When utility-driven demand begins to align with institutional capacity, the repricing is non-linear. It is not measured in incremental gains. It is measured in the speed and magnitude with which markets adapt once the broader system acknowledges the shift. Most participants will miss this. They will look back and assume it happened suddenly. But the truth is far more deliberate. The quiet phase is where the informed few establish dominance, creating asymmetry that becomes apparent only later. And the next move? It will not be obvious until it has already begun. What nobody is ready for is not a single price spike. It is a transformation in role and perception. XRP is evolving from a speculative instrument into a functional asset within institutional corridors. Its utility is becoming embedded in cross-border payments, liquidity management, and settlement infrastructure. When the market finally internalizes that shift, the reaction will be unlike anything measured purely by prior trading patterns. This is why the win feels invisible. Price is not the signal, participation is. Banks, regulated entities, and other large-scale players are quietly establishing positions. They are less concerned with short-term volatility and more concerned with operational access, regulatory compliance, and scalability. For retail participants, this phase can feel frustrating. It is neither dramatic nor emotionally satisfying. But for those who understand the underlying dynamics, it is precisely the point at which asymmetric opportunities are created. The market is separating signal from noise, patience from impatience, insight from speculation. When the system fully recognizes XRP's structural role, the repricing will reflect utility, not hype. The move will be rapid, non-linear, and largely invisible until it unfolds. For the informed observer, the conclusion is clear. This phase rewards calm, conviction, and comprehension of the bigger system. Those who panic or chase will miss it. Those who understand will already be in position. At this point, it becomes essential to reframe how we measure success. Most participants judge performance by immediate returns or visible volatility. But XRP's current win is not measured in dollars or charts. It is measured in access, legitimacy, and systemic positioning. The next phase of growth will not follow the patterns of hype-driven assets. It will be dictated by adoption and integration into existing financial networks. As Ripple's technology becomes increasingly embedded in regulated payment corridors, the asset's role shifts from optional speculation to operational necessity. And when utility drives demand at scale, the market response will be structural rather than emotional. This is the quiet advantage for those paying attention. The majority of participants, conditioned to react to headlines, will misinterpret this phase as indecision. They will exit or remain on the sidelines. Meanwhile, a smaller, informed cohort, the patient and perceptive investors, will already have established positions, understanding that the real catalyst is participation, not publicity. So, when the broader market finally acknowledges the transformation, the price will no longer move in linear increments. It will leap, reflecting the accumulation of utility-driven demand that has quietly built over time. The final realization is simple yet profound. XRP's victory is not over price, it is over perception. What has changed is the asset's role in the financial system. It has moved from being a speculative token debated on forums and Twitter feeds to becoming an operational bridge for regulated institutions. The legal clarity, the banking integrations, the evolving payment corridors, these are the signals most participants cannot see in real time. They are subtle, structural, and often invisible to anyone outside the system. When these forces align, regulation, infrastructure, and institutional participation, the repricing will be rapid and non-linear. The phase we are witnessing now is the rare period when those who understand the system can establish positions quietly before the majority even realizes the move has begun. Patience and conviction are the true currencies in this phase. Most will miss it, misinterpret it, or abandon it out of frustration. But those who observe calmly, who recognize the absorption, the silent accumulation, and the structural transformation, will already be ahead. XRP has won its legal battles. It has won institutional legitimacy. And what comes next is not hype. It is a systemic evolution that very few are ready for.